Phillips 66 PSX presents a compelling investment proposition primarily oriented toward income generation and capital preservation within the integrated energy industrial sector. The foundational investment thesis rests on the robust diversification of its earning streams, midstream, refining, and chemicals, which provides a critical defensive mechanism, insulating the company's capital return strategy from the extreme cyclicality inherent to refining operations. The analysis concludes that the dividend is fundamentally safe and sustainable, despite quantitative metrics derived from statutory earnings that appear alarming. Specifically, the reported payout ratio, which exceeds 125% of trailing earnings, is a temporary distortion caused by substantial non-cash accounting charges recognized during Q3 2025. When coverage is measured against adjusted operating cash flow, the dividend is shown to be covered multiple times over, validating the sustainability of the company's 11-year dividend growth streak. On a valuation basis, the stock appears expensive when viewed through the lens of trailing price to earnings. However, assessment based on forward normalized earnings and enterprise value (EV) multiples reveals that PSX is reasonably priced relative to its expected profitability and its integrated business structure. Analysts anticipate moderate capital upside, suggesting the total return profile will be driven predominantly by the attractive 3.5% dividend yield and consistent share repurchase programs. II. Operational context and strategic foundation for financial stability. IA. Q3 2025 performance and segment diversification. The operational performance in the third quarter of 2025 demonstrated exceptional execution and structural efficiency across the Phillips 66 portfolio. The company reported adjusted earnings of $1.0 billion, or $2.52 per share, with adjusted EBITDA reaching $2.594 billion, exceeding consensus estimates. This robust performance was supported by world-class operations in the refining segment, which achieved 99% capacity utilization and an 86% clean product yield. The diversified business structure, comprising refining, midstream, chemicals, and marketing and specialties, serves as the primary risk buffer for the enterprise. In the third quarter of 2025, the midstream segment was the largest contributor to adjusted EBITDA, generating $964 million. This segment, characterized by consistent fee-based earnings, forms the defensive core of Phillips 66's cash flow profile. In comparison, the highly cyclical refining segment contributed $904 million, benefiting from realized refining margins of $12.15 per barrel. Crucially, the chemical segment exhibited a strong cyclical recovery, contributing $308 million to adjusted EBITDA in Q3 2025. This represented a dramatic sequential increase of over 100% from the second quarter. The strategic role of the midstream segment is paramount. Its stable, predictable earnings provide a counter-cyclical cash flow stream. This guaranteed base coverage mitigates reliance on peak refining margins, directly ensuring the company can meet its commitment to return at least 50% of cash from operations to shareholders, irrespective of the refining's current position. 8. The consistency delivered by these non-refining assets is the structural component that enables PSX to sustain its dividend growth commitment. IB. Strategic initiatives enhancing portfolio quality. Phillips 66 is actively engaged in simplifying its corporate structure and optimizing its asset base, initiatives that enhance the long-term quality and stability of its cash flows. A pivotal strategic move was the acquisition of the remaining 50% interest in WRB Refining LP, granting PSX full ownership of the Wood River and Borger refineries, a transaction completed in October 2025. This acquisition is designed to enhance margin capture and streamline the operating portfolio. Furthermore, management has outlined plans to monetize non-core assets that no longer align with its long-term strategic direction, targeting proceeds in excess of $3 billion. These planned asset sales, when combined with the portfolio simplification initiatives, like the WRB acquisition, are intended to improve the overall resilience and efficiency of the company. The monetization program provides a substantial cash injection that can be strategically deployed for debt reduction, thereby improving long-term financial stability and accelerating the company's balance sheet repair goals. IV, Deep Dive, Analysis of Dividend Safety and Payout Sustainability. IA, Historical Commitment and Yield Metrics. Phillips 66's commitment to shareholder returns is evidenced by its track record of continuous dividend growth, a period now spanning 11 consecutive years. This history confirms management's prioritization of capital return as a core component of its strategy. The company currently pays an annual dividend of $4.80 per share, corresponding to an attractive yield of approximately 3.5% based on recent market prices. The 5-year annualized dividend growth rate stands at a robust 7.12%. The last quarterly dividend payment was $1.20, distributed in December 2025. IB, Deconstructing the Payout Coverage Paradox. A superficial analysis of the reported dividend metrics yields a highly misleading conclusion regarding safety. Phillips 66's statutory payout ratio, calculated based on trailing net income, sits dangerously high, reported between 125% and 128.4% of earnings. A ratio exceeding 100% traditionally implies that a company must use external financing or draw down cash reserves to cover the distribution, signaling immediate unsustainability. However, a granular examination of the company's financial results reveals that this distortion is entirely attributable to substantial one-time non-cash special items recognized in the third quarter of 2025. Specifically, the GAAP earnings of only 0.3 cents per share were depressed by items totaling over $1 billion, including a large refining impairment charge of approximately $948 million related to the WRB joint venture and $241 million of pre-tax accelerated depreciation related to the Los Angeles refinery. Since the dividend is a cash expense, and these are merely non-cash accounting adjustments, the statutory net income metric drastically understates the true economic cash generative capacity of the business. The stability of the dividend must be assessed through cash flow. The divergence between the poor GAAP earnings coverage and the robust cash flow coverage mandates that analysts prioritize free cash flow analysis during periods of cyclical volatility or corporate restructuring. In Q3 2025, PSX generated $1.9 billion in net operating cash flow, excluding the effects of volatile working capital changes. In contrast, the company paid out $484 million in dividends during the same quarter. This comparison indicates that the dividend obligation was covered approximately 4 times over by the adjusted operating cash flow in that period. Even after accounting for capital expenditure, which totaled $541 million in Q3 25, the residual cash flow remaining after funding all maintenance and growth capital was still substantial, proving that the dividend is comfortably covered by free cash flow. Management's decision to maintain and grow the dividend payout consistently, even amid reporting temporary earnings compression due to strategic asset rationalization, communicates confidence in the long-term health of the underlying cash engine. This action signals that the substantial non-cash impairment is merely a one-time accounting cleanup necessary for portfolio simplification, rather than a fundamental indication of financial weakness. IV, Financial Health, Capital Structure, and Credit Profile. IA, Leverage Management and Credit Rating Integrity. Phillips 66 maintains a strong focus on preserving its investment-grade credit ratings and managing its capital structure prudently. As of the third quarter of 2025, the company reported total debt of $21.8 billion. The key leverage indicators show a debt-to-capital ratio of 44%, with the net debt-to-capital ratio standing at 41%. Management has established clear, disciplined goals for its capital structure, aiming for a long-term net debt-to-capital ratio in the range of 25 to 30%. The priority of maintaining strong investment-grade credit ratings is explicitly stated. 8. This commitment is confirmed by external ratings agencies, such as S&P Global Ratings, which assigned a BB- rating to a proposed issuance of junior subordinate notes in late 2025. Preserving this investment-grade status is crucial, as it limits interest expense volatility and ensures stable access to capital markets, which fundamentally reduces systemic financial risk.
IV.B, Liquidity and Debt Reduction Trajectory. The company's ability to generate strong cash flow is critical to achieving its leverage targets. In the third quarter of 2025, cash and cash equivalents increased, reaching approximately $2.0 billion. This improved liquidity provides essential operational flexibility. The path to achieving the targeted 25%-30% net debt-to-capital ratio is highly reliant on two factors: sustained, strong adjusted operating cash flow, approximately $1.9 billion, excluding working capital fluctuations, and the successful execution of the planned asset monetization program. Given the mandate to return at least 50% of cash from operations to shareholders, organic debt reduction alone would necessitate an extended timeline. Therefore, the successful execution of the over $3 billion asset monetization plan is the necessary non-operating catalyst required to accelerate the deleveraging process and rapidly bridge the gap between the current 41% net leverage and the desired 25% target. This operational discipline, anchored by the priority of maintaining investment-grade status, ensures that debt reduction and financial stability will not be sacrificed for unsustainable increases in shareholder returns. V. Valuation assessment: multiples, cyclicality, and historical context. V.A. Trailing and forward earnings multiples analysis. A key challenge in valuing Phillips 66 is the significant distortion present in trailing earnings multiples. The company currently trades at an extraordinarily high price-to-earnings (PE) ratio of 37.02x. This multiple is 125% higher than the company's 10-year historical average PE of 16.46x. As previously established, this severe elevation is not indicative of unsustainable stock price appreciation, but rather of the temporary non-cash impairment charges recognized in Q3 2025, which artificially suppressed the trailing earnings denominator. For investors seeking a normalized view, valuation must shift to forward-looking metrics. When analysts filter out this accounting noise, the valuation becomes much more compelling. The estimated forward PE ratio is projected to be in the range of 11.5x to 11.64x. This forward multiple sits significantly below the company's long-term historical average, strongly implying that the market and analysts anticipate a vigorous return to normalized profitability, confirming that the stock is currently priced based on expected operational cash flow rather than statutory accounting losses. V.B. Enterprise value to EBITDA analysis and peer comparison. Given the volatility of refining earnings, the enterprise value to EBITDA (EV/EBITDA) ratio is often the superior metric for comparative analysis. Phillips 66's latest 12 months LTM EV/EBITDA is reported at approximately 11.76x. While this figure must be contextualized against the overall sector median, which is remarkably low at 3.5x, the comparison validates that PSX is not priced as a pure cyclical commodity refiner. The valuation differential relative to key refining peers provides deeper perspective. Marathon Petroleum (MPC), a major competitor, trades with an LTM EV/EBITDA of 8.8x. Phillips 66's materially higher EV/EBITDA multiple of 11.76x suggests that the market assigns a significant and durable premium to the company. This premium is directly justified by the stability and diversification provided by the integrated midstream and chemical segments, which stabilize cash flow and mitigate the systemic risk associated with being a pure-play refiner. PSX is therefore valued as a higher quality, more resilient industrial energy complex. Currently, shares trade at approximately 11 to 12 times forward earnings, which analysts consider largely in line with expectations for diversified energy peers. This fair valuation implies that the benefits of the diversification strategy are already fully captured in the current stock price. Therefore, while the company is well positioned for stability and income generation, the potential for explosive capital gains is constrained unless the refining industry enters a sustained period of exceptional profitability. Future capital appreciation will likely be moderate, requiring investors to rely on the consistent 3.5% dividend yield and ongoing share repurchases to realize competitive total returns. V. Analyst consensus and investment outlook. The general investment outlook for Phillips 66 remains positive, centering on its stability and income potential. The consensus rating, derived from 20 analysts tracking the stock, is buy. The average 12-month price target provided by analysts is approximately $148.65, ranging from a low estimate of $133 to a high estimate of $170.06. With the stock currently trading near $137 per share, the average target implies a potential capital upside of about 8.54% over the next 12 months. This expectation aligns with the assessment that Phillips 66 offers modest capital appreciation potential. Analysts agree that the company's focus on disciplined capital use, cost efficiency, and simplification positions it well for steady shareholder value creation, reinforcing its primary role as a dependable, income-driven energy stock built for stability. V. Conclusion. Phillips 66 maintains a strong, defensible investment position, fundamentally supported by resilient cash generation from its diversified asset base. The analysis of dividend safety conclusively demonstrates that the 11-year dividend growth streak, currently yielding 3.5%, is robustly funded by cash flow from operations, notwithstanding the misleadingly high statutory payout ratio caused by temporary non-cash restructuring charges. Valuation assessment shows that while the stock appears dramatically expensive based on trailing earnings, forward-looking and cash flow-based multiples suggest a fair valuation that appropriately captures the premium warranted by the stability of its midstream and chemical segments relative to pure-play refiners. Future returns are expected to be derived from the consistent dividend payout and share repurchases, with capital appreciation anticipated to be moderate rather than aggressive. The core investment thesis is that Phillips 66 offers disciplined financial management and a highly reliable income stream within a cyclical industry.